I run every IPO through the same 6-step checklist before I let myself have an opinion. No exceptions. This defense deal clears the first 3 steps. When it hits step 5, the whole story changes. Let me show you where it breaks for me in real time. The company is Lyntris, a $2.5 billion defense firm, riding the drone war boom, going public into the hottest listings wave in a decade. I won't tell you whether to buy it. I'll hand you the checklist I use, the one the institutions use, and run this live deal through it, one step at a time. Muscle, market, underwriter, strength of industry, core fundamentals, legal documents, early trading, the rule that makes it work. If a stock fails any single step, it's out. Watch how far this one gets. Hey, welcome to New Stock Signals. I'm Bill Smith, founder of Renaissance Capital, which for over 30 years has analyzed more than 11,000 IPOs. I read every comment, so be sure to share your thoughts below. Nothing in this video constitutes personalized investment advice. Always consult your own financial advisor before making investment decisions. Most investors evaluate an IPO by reading the headline and checking how they feel about it. That's not a process. Muscle strips the emotion out. It's a pilot's pre-flight checklist for a new stock. Pilots don't skip the checklist because they're nervous. They run it because memory fails under pressure, and nothing pressures you like a hot IPO everyone's excited about. By the end of this video, you won't just know my read on this one deal. You'll own the checklist. You'll be able to run it yourself on the next name that lands in your feed. We go letter by letter in order. Each one is a gate. Clear it, move on, fail it, we stop. First letter, M market. This is the weather report for IPOs. Is the market even open? The tell is simple. Are recent new listings making money in the aftermarket? When they are, institutions come back for more. Wall Street calls it the IPO market is open. Right now, we're in the biggest listings wave in a decade. Recent deals are trading well. The ducks are quacking. Market pass. Move to you. Underwriter, the bank running the deal. Some banks have a gift for picking winners and standing behind them. Here's how I score it. Pull the lead underwriter off the front of the S1. Well-known name? Good. Lyntris' deal is co-led by Evercore, Citi, and Guggenheim. Top-tier banks with solid recent records. Underwriter, pass, 2 for 2. Move to S. Strength of industry. Is the company riding a tailwind or fighting a headwind? I don't care how good the product is. Put a brilliant company in a dying sector and it swims upstream forever. Defense right now? Global spending is climbing. Drones are rewriting modern warfare. Money is flooding into the exact niche this company sits in. Those tailwinds are as real as they come. Strength of industry, pass, 3 for 3. Here's where most people would stop reading and hit buy. Don't. We're only halfway. Fourth letter, core fundamentals. This is where the numbers become the adult supervision in the room. Strip the branding. How's revenue? Margins? Is the company actually profitable? There's some good. The backlog, contracted future revenue, roughly doubled to around $924 million. But here's the other half. Lyntris is still unprofitable on a net basis. Backlog is not profit. It's revenue you haven't earned yet and haven't proven you can turn into earnings. At this step, Lyntris doesn't cleanly pass, but it doesn't cleanly fail. Strong top-line signal, no bottom-line proof yet. I flag it and keep going. Core fundamentals mixed onto L. This is where the deal shows its hand. Fifth letter, legal documents, the S1. This is where the weirdest surprises live and where almost every retail investor stops reading. This is the step that broke the deal for me. I pulled the S1 and went to one page. Use of proceeds. It's one page. It's not hidden. It tells you where the money actually goes. The deal raises $492 million at the midpoint. Lyntris keeps about 20% of it. The other 80% goes straight to existing shareholders on the way out the door. Roughly 4 of every 5 shares sold in this IPO aren't the company raising money to grow. They're insiders cashing out, and it gets sharper. Read further into the filing, and you find out what this company is. It's a roll-up created by private equity firm Trive Capital, a private equity firm that's bought 12 defense suppliers since 2018. 3 months ago, they stitched 2 of them, Vitesse and Excellent, to create the entity that's going public today. That's a secondary heavy offering from a 3-month-old roll-up priced as a growth story. On my checklist, that's a failed L. Insider payout structure plus off-the-shelf corporate history is exactly the kind of surprise the legal step exists to catch. Sixth letter would be early trading, watching who actually buys and sells in the first days, whether institutions accumulate or ghost the listing. But here's the whole point of the method. I don't need to run E. The stock failed for me at L. And the rule is, fail any single step, you're out. You don't talk yourself past it because the first 3 letters look great. Here's what I want you to take from this. First, the order matters as much as the steps. If you jump straight to the exciting stuff, the sector, the story, you'll fall in love before you ever open the S1. Muscle forces you through the boring gates first on purpose. Second, the L step is where retail gets separated from the pros. Read the use of proceeds page on every deal, one page. It tells you whether you're funding growth or funding someone's exit. Third, a failed step is a full stop, not a suggestion. The hardest part of this method isn't the analysis. It's the willingness to walk away from a great sounding company. Some weeks I screen 15 names and pass pass on all 15. That's not failure. That's the method working. And notice what muscle did here. It didn't tell me this is a scam. It isn't. It told me precisely where the risk lives, so I'm not surprised by it 6 months from now when the lockup expires and more insider stock hits the market. The checklist doesn't make the decision for you. It makes sure you decide with your eyes open. Let me address the pushback. Bill, roll-ups go public all the time. Private equity exits are normal. Why fail the deal over it? The structure is common. Insiders selling isn't a scandal. In a normal IPO, the public owns maybe a fifth on day one, and early investors sell down over time. That's healthy. The failure isn't that insiders are selling. It's the ratio plus the 90-day history plus a price tag built on a growth narrative. For me, that's beyond my comfort zone, but I'm not making a prediction. I'm applying a rule consistently, even when the story is exciting. Second objection, you marked C as mixed and L as a fail. Isn't that just your opinion? The verdicts are judgment, but the inputs aren't. The $492 million, the roughly $100 million the company keeps, the doubled backlog, the 90-day-old entity, those are in the filing. You can run the same checklist and reach your own call. That's the point. I'm handing you the process, not the answer. Here's the scorecard. Market, pass. Underwriter, pass. Strength of industry, pass. Core fundamentals, mixed. Legal documents, fail. Early trading, never reached. A good sector and a real backlog, stopped cold by what the S1 revealed about who actually gets paid in this deal. That's muscle, 6 gates in order, and the discipline to stop at the one that breaks. If this is the kind of process you want, subscribe. Hit like so more self-directed investors find this. And the full muscle method, all 6 steps in depth, is in my book, The New AI Stock Edge. Pre-orders link below. Run every IPO through all 6 letters, because the deal that clears the first 3 can still break on the one everyone skips.